the Building African Financial Markets Seminar. This is the 6th of the Building African Financial Markets Seminars, and it's great to have so many of you coming from all over Africa in order to share. This is a room full of our common passion, which is how do the capital markets fuel the development both of our countries and of our great continent. So this is, if you think about it, this is like a university of capital markets development. We're going to not run it very much as a conference. The organizers have explained that it's aimed at learning experience. So we'll have presentations throughout the day, we'll have panels tomorrow, and in each case there will be chances for you to interact. So you're here to learn, you're here to share your expertise, you're here to bring your regional expertises and so on. Thank you very much to our hosts, the Bourse de Casablanca, a sprightly 88-year-old stock exchange, still full of dynamism, still continually developing new strategies, pushing forward. The Moroccan regulator, the Moroccan clearing and settlement system, and thank you for bringing us to this amazing venue. I don't know if you know, but Anfa, the name of the place, that name has apparently been around for 2,800 years as being the name of this place, which puts some of our countries a bit in perspective since we haven't been around for that long. But this has been a commercial center for all of these years, and it's a beautiful venue, as you've seen. The swimming pool is closed, so you can't slip out and jump in the swimming pool. You have to stay and keep working, but that's what we've come here for, is to learn a lot. I'm not going to delay, but just to congratulate everybody on organizing this amazing program. It's the first time for me to see a conference which covers so many of the aspects that capital market development is always an ecosystem. You need the institutional investors. We're talking about pension funds. You need the private equity, you need the listings, and you need the regulators. And I'm very, very happy that we've got so many regulators from different parts of Africa here, as well as capital markets developments. I think I counted 6 or 7 African stock exchanges on the agenda, let alone in the audience, and also stock exchanges from other parts of the world, including London, Montreal, and so on. So people coming from all over the world to share what we've seen, global best practices to enhance the African capital markets. Now I'm going to aim not to talk too much today, but just to try and keep timing so that we move forward fairly well. And what I would like to do, I think, is to launch off straight away without much further delay by inviting Mr. Karim Hadji, who's the CEO of the Bourse de Casablanca, to do the welcoming address as our host. Mr. Karim Hadji.
Mrs. Nizha Hayat, Chairwoman of the Moroccan Capital Markets Authority, ladies and gentlemen, welcome to Casablanca. Africa has a date with history. Our continent is for sure evolving amid several current uncertainties, but remains vigorously strong and carries great promises for the world economy. With 15% of the world's natural resources lying beneath its soil, the decline of oil and raw material prices has certainly taken its toll on the economic dynamics of the continent in the last decade. But it is far from putting an end to it. The continent's GDP, which has dropped from 6% in 2006 to 2.6% in 2017, according to the latest projections of the IMF, is expected to rebound in the coming years. Africa still holds the largest growth potential among all continents, and the figures speak for themselves. In 2050, Africa will be home to a quarter of the world population. Over 1 billion Africans will belong to the middle class in 2060, against 355 million in 2010. The continent is expected to produce 15% of the world's energy resources in 2020. Turning this exceptional potential into inclusive and sustainable opportunities will be accompanied by a significant expansion of financing needs. In order to meet such important needs, the mobilization of all available financial resources will also have to be exceptional. Financial market participants, in particular, are invited to develop innovative solutions that are adapted to the continent's specific needs. In this context, and in light of the new South-South economic diplomacy spearheaded by His Majesty King Mohammed VI, the King of Morocco, Morocco is positioning itself as a partner on the continental scene. The return of the kingdom to its natural family within the African Union and its application to ECOWAS reflects clearly and in a practical way this new approach. I remind you that His Majesty said during a speech in Abidjan, Africa must trust Africa. Today, more than 3,200 bilateral agreements are linking the kingdom to African partners. And these partnerships cover several sectors of activity and have led to several large projects. Casablanca Stock Exchange is no exception to this. We have signed agreements with Nigeria Stock Exchange, with BAFM and Ghana Stock Exchange, as well as Tunis Stock Exchange, because we believe that connecting capital markets is key to contributing to growth on the continent. This philosophy of connecting African exchanges has given momentum to the creation of the ASEA, the African Securities Exchanges Association, in 1993, with the goal of bringing the African stock exchanges together, exploring collaborative opportunities between their members, and enhancing exchanges of information and experience among them. This philosophy has also led to several partnerships agreements between the African stock exchanges. More importantly, I believe we should work in close collaboration with all the market stakeholders, regulators, stockbrokers, asset management companies, securities, depositories, CCPs, and so forth, so that we boost capital markets within the African region, both West Africa, North Africa, East Africa, and Southern Africa. Along the same line, and for the sake of sustainability, the Moroccan authority in charge of capital markets, AMMC, and Casablanca Stock Exchange have jointly launched back in November 2016, the initiative, the Marrakesh Pledge initiative for fostering green capital markets in Africa. This initiative seeks to create the necessary conditions to enable the African continent to become one of the world's major green financial markets. The African exchange's contribution to the development of the continent's economy is today more than essential for financing the development of African companies, which are indeed an effective driver of economic development. They create wealth and jobs for everybody. They're expected to meet the needs of numerous economic sectors, and therefore there is no reason for African countries to be an exception to this rule. African exchanges should act as an effective means of financing for all our economies in order to build a global, sustainable, and effective African environment. We need to work together and join our respective forces, and we should not hesitate to pool our resources, whether in market development or training. We should promote strong and attractive companies by extending our activities to the preparation of African companies to the capital market, as we are doing today in Casablanca with the Elite program. We should also educate the market by investing heavily in training, which is done by many exchanges today across the continent. This is why, and in order to maintain the shared dynamics of African capital markets, we are honored to welcome you today in Casablanca at the 6th edition of Building African Financial Markets. This meeting, aimed at building the capacity of African financial markets, is all the more important as it is the first of its kind to be held in North Africa. I would like to take this opportunity to thank the President of ASEA and the members of the Executive Committee for choosing Morocco to hold this meeting. We have exciting panels awaiting us today and tomorrow. We'll be talking about green economy, talking about derivatives, commodities, also the impact of the new economic policy in the US on emerging markets. We'll talk also about liquidity, all issues which are of great importance to African stock exchanges. In conclusion, I thank all of you for your contribution to the common dynamics in favor of a winning Africa, a land of opportunity for the global economy. Thank you very much. I would like to call, with no further ado, my friend Oscar Onyema, President of the African Securities Exchanges Association, for the opening speech. Thank you. Thank you, Oscar.
Thank you very much, Karim, for the warm welcome. Distinguished guests, colleagues, partners from across the continent and beyond, very good morning to you all. On behalf of ASEA, I join the CEO of the Casablanca Stock Exchange, Mr. Karim Haj, in welcoming you all to this 2017 Building African Financial Markets BAFM Capacity Building Seminar. I am sure that I speak for most of us when I say it is a great pleasure to be here in the beautiful city of Casablanca for the 6th edition of this seminar. I am particularly pleased that this year's edition of the BAFM is holding in North Africa, following last year's maiden edition in West Africa, which marked the first time the seminar held outside of South Africa. Indeed, this reflects ASEA's efforts to expand its reach and participation across all regions of the continent. This seminar is the first major outing of ASEA in 2017. For many of us here, 2016 was a challenging year. Against the backdrop of sustained lower commodity prices, weakened currencies, slower than expected global growth, and heightened political uncertainty, capital raising activity in African stock markets declined by up to 33% in US terms over the previous year. The subdued activity mirrored global developments as the World Federation of Exchanges reported that 2016 saw the slowest start to the year for global equity markets in over a decade. I highlight these issues not to paint a picture of uncertainty, but for us to recognize firstly that African financial markets remain inextricably linked to the global economy and must respond flexibly to emerging trends in economic and policy developments. And secondly, because a number of these conditions will continue to influence the performance of our markets in the near term, thus presenting challenges to our businesses, but also making this an opportune time to take a step back and re-strategize on how best to grow our markets and build resilience and competitiveness under diverse economic conditions. Indeed, this seminar affords us and every one of us here, each and every one of us here, the opportunity to do just that. This year's theme, Global Best Practices to Enhance the African Capital Markets, is simple yet apt. It captures the essence of the Building Africa Financial Markets, a forum to share insights and best-in-class practices that will stimulate the growth of African financial markets. Accordingly, over the next 2 days, we will discuss a range of topics critical to our industry, including regulation, corporate governance, market infrastructure, and technology, with a view on policies, procedures, and structural recommendations that can be adopted or indeed adapted in our various markets to unlock new opportunities. It is not a one-size-fits-all approach. Ultimately, we must all evaluate recommendations from these sessions against the complexities of our own market structure, the need of our ecosystem, and the level of market development in order to determine the levers that will yield the greatest liquidity or competitive advantage for a particular market. African exchanges have made significant strides, increasingly adopting international standards and joining global associations such as the World Federation of Exchanges, with whom ASEA shares a common vision and which now counts 5 African exchanges in its membership. However, there is more to do to increase the competitiveness and sustainability of the African capital markets, which requires concerted efforts of the entire capital market community, as well as governments and policymakers. On its part, ASEA has undertaken various initiatives to align itself and member exchanges with the highest global standards, including 1, a partnership with the African Development Bank to develop financial market infrastructure and products for African exchanges, amongst other areas of cooperation. 2, partnership with the leading global index provider FTSE to develop the Africa FTSE Pan-African Index. 3, transformation of the ASEA website to a world-class platform for disseminating market news and statistics, including live market feeds to the global investment community. And 4, collaboration with leading global institutions such as the Chartered Financial Analysts Institute, CFA, and the Chartered Institute for Securities and Investments, CISI, amongst others. By the way, these agreements are designed to make the certifications more easily available to market operators across Africa at very, very reduced rates if you come through ASEA. On a final note, I would like to take this opportunity to expand my appreciation to our sponsors, Bloomberg, the London Stock Exchange Group, and Maroc Claire, as well as our media partners. I also acknowledge the presence of the Moroccan Authority of Capital Markets and Casablanca Financial City Authority. We are grateful for your support and participation. To my good friend Karim and the entire team at the Casablanca Stock Exchange and the ASEA Secretariat who have worked tirelessly to put this seminar together, I thank you very much for your efforts in making this a very successful event. Building African financial markets is our collective responsibility. Hence, we must seek out knowledge that empowers us to remove impediments to the advancement of our markets. I have no doubt that the discussions over the next 2 days will provide us a greater perspective on learnings which will help us advance the development, excuse me, advance the development of our markets and leave us better positioned to unlock our continent's growth potential. Thank you very much.
Thank you very much to the President of ASEA. I would now like to call on Nezha Hayat, our host as well, and President of the Moroccan regulator. Thank you.
Good morning, distinguished guests, ladies and gentlemen. Well, good morning and welcome to Casablanca. I'm very happy to be with you today at the opening of the 2017 session of BAFM seminar. Building African Capital Markets. I'll first thank Karim Haji, the CEO of the Casablanca Stock Exchange, and Oscar Onyema, the chairman of ASEA, for inviting me today to share a few thoughts with you. I won't be long. Before you start this seminar, the BAFM seminar, which has proven to be an important venue for constructive exchange. Your seminar today is about global best practices to enhance African capital markets, with a special focus on subjects such as green financing, innovation, as well as SMEs' access to markets. Well, I wish I could be with you during these 2 days of your seminar, for these important issues are key issues in the strategy and the roadmap of our Moroccan Capital Markets Authority. Let me recall your mission as a regulator. Mission is to ensure the protection of savings invested in financial instruments, ensure equal treatment of investors, transparency and integrity of the capital market, as well as of the investors' information. We regulate participants and products on Morocco's capital market, including financial markets and market infrastructure, listed companies, brokers, asset management companies, and the collective investment products invested in financial instruments. The capital markets that we oversee are experiencing rapid innovations and constant change. Our markets have to play a critical role in the development and transformation of our economies towards more sustainable and more resilient development trajectories. And this is happening in many countries of our African continent. It is therefore important that capital market regulators, exchanging, financial policy makers engage firmly in building an adequate financial environment together with financial professionals and all stakeholders of the market. This not only nationally, but we need strong partnership and comprehensive collective action among our African capital markets to build efficient and resilient capital markets more involved in the financing of our economy. And one major challenge for our stock exchanges is to attract more listing. And this is an issue that we are also working within AMERC, the African and Middle East regulators. As mentioned earlier by Karim Haji, we have successfully launched in November 2016 during COP22 most of the African Stock Exchanges and Financial Markets Regulator, an initiative to foster green capital markets in Africa. Also, we, with Casablanca Stock Exchange, we are developing bilateral cooperation with exchanging and financial regulators with important countries like Nigeria or Ghana in Africa to set up the conditions of more and more integrated markets within our great continent. Well, I wish you a successful seminar, and I thank you for your kind attention.
Thank you very much for the welcoming addresses from Karim Haji from the Casablanca Stock Exchange, Oscar Onyema, the president of Nigerian Stock Exchange. It's great I was at, this is not quite the first seminar of ASEA. My name's Tom Minney. I used to run Namibia Stock Exchange in the 90s, but I was at the second one of ASEA in 1994 on a panel, and I don't think people would have imagined in those days both how big the capital markets would have grown in the interim and how big ASEA would have grown as a sort of effective body that actually believed in working sessions, in sharing knowledge, and as the colleagues were saying, both Nezha Hayat and Karim Haji and Oscar have all been talking about the cooperation between exchanges. So there is competition, but there's so much that exchanges can do together. I'm not going to delay because the next session is also drawing the same theme. It's about Casablanca Finance City, which is Morocco reaching out into the rest of Africa and offering infrastructure. Is Mr. Mohamed Rashid here? Can I welcome you up to the stage? This is Mr. Mohamed Rashid, Deputy Director in charge of relations from the Casablanca Finance City. Thank you very much. Let me hand over.
Well, good morning. Before we get started, I want just to take a couple of seconds to thank the organizers, the Casablanca Stock Exchange and African Securities Association, for inviting me here. It's a great honor. Well, I'm invited today to say some words about building a financial hub. If I have to say it in a couple of words, let me be clear about this. It's a tough, complex, and complicated task. It's also challenging, and there is a lot of work to do it, and it's not going to happen overnight. Honestly speaking, I have hesitated a lot before choosing today between giving you some insights, some views and comments about building a financial center and telling you the story of Casablanca Finance City, instead of giving a PPT presentation, I would say, full of boilerplate language. I hope you will find my words worth your attention, and I will go straight forward to the topic of my presentation. Well, when we think about building a financial center, there are many important issues. All the issues are important, but there are four critical big issues that we have to think about it. First is the long-run sustainability of our macroeconomic environment. As the success story of building Casablanca Finance City Financial Center shows, remember that at the beginning of the ideation process of the creation of CFC in 2007, 2008, and at the beginning of the cross-fertilization process between all the financial market stakeholders, all the accounts were under control. The fiscal balance in 2007 and 2008 was in surplus. The current account of balance of payments accumulated at that time more than 7 years of surplus. The Moroccan economy jumped for the first time in his history in 2007 from speculative to join the club of investment grade, allowing Moroccan groups' ambition to become key players in the region, facilitated because their own rating by definition limited by the sovereign risk improved. Morocco issued at that time its first Eurobond in 2007 as investment grade. Moreover, during the decade preceding the launch and the building of the financial center, the Moroccan economy achieved a high growth performance of more than 5% with exceptional years, like 2008 with a GDP growth of 6% and 2006 with a growth rate of 7.6%. This is to say that long-run sustainability of macroeconomic environment is crucial objective in building a financial center. Other positive glimmers of hope or flashes of green lights that triggered the ambition of the launch of the financial center was also the fact that the major market indices of the Casablanca Stock Exchange experienced peaks in 2007 and 2010. Market cap reached a peak of 95.1% of GDP in 2007. Currently, it stands at just over half of GDP. Ladies and gentlemen, the second critical issue we have to think about in building a financial center is doing business environment. A good place to start building a financial center is to improve the economy's regulatory environment for business. Morocco has done a lot in this field. We are ranked 68 in doing business 2007, where economies are ranked from 1 to 190. We have excellent ranking in some doing business topics, starting a business where Morocco stands at 40 in the ranking. Paying tax, where we are ranked 41. Even better than countries like France, ranked 63 in this topic. And dealing with construction permits, where we are ranked 18, 1-8, among 190 countries. These are just some examples of the tremendous efforts undertaken by Morocco to improve the doing business environment, knowing that just 5 years ago, in just 2012, Morocco was the top reformer globally by improving its business regulation the most compared to other global economies, and then climbing 21 places from 115 to 94 in 2012. Ladies and gentlemen, the third critical issue that we have to think about when building a financial center is reforming the financial sector. Morocco has engaged in important structural reforms, and the financial sector was placed at the heart of this reform's dynamics. The Moroccan financial sector has seen a deep change of its regulatory and institutional framework to bring it in line with international standards and to align it with the ambition of building a financial center. Casablanca Finance City Authority was a real forcing device in this harmonization process. Between 2012 and now, more than 20 laws related to financial sector have been introduced in the adoption process. Half of them have been definitely enacted, including the new law of Casablanca Stock Exchange, the laws of derivative markets, the rates, private equity, securities lending and borrowing, the law of securitization with provisions related to sukuk, new banking law with provisions related to Islamic banking, new insurance law with provisions related to Islamic takaful, and new laws of the three regulators of the three subsectors of financial sector. 2 of them are already entered into force. Moreover, in recent years, Morocco has built a fairly diversified financial system that grows rapidly. System assets, including banking, insurance, pension funds, asset management, have reached levels comparable to high-income countries. For asset management, for example, we have reached 380 billion of dirhams of asset under management. Now, the banking system and the insurance system are among the largest in the region. And according to Global Competitiveness Report 2016 and 2017, the last one, Morocco is globally ranked 83 among 138 economy in financial market development pillar, with a very good performance in terms of regulation of securities exchanges, where we are ranked 36 among 138 economy and 55 among 138 markets in terms of market size, including domestic and foreign market size. Ladies and gentlemen, the fourth critical issue is related to governance, management, and value proposition of the financial hub. In 2010, the Parliament passed the law to establish the Casablanca Finance City, the CFC, as regional financial center and hub for financial institutions, multinational companies, and professional services providers, and to create CFC Authority as the public-private partnership body responsible for overseeing the development, promotion, and management of the financial center. We reformed this law in 2014, and the new draft law has been prepared and submitted to the head of government for review. This is to say that building a financial hub is an endless task and a complex one. Each and every day, we have a lot of back and forth with the authorities about the value proposition of CFC in terms of taxes, tax incentives, exchange control facilitations, ease of doing business measures, and other reforms of laws, rules, and regulations needed to enhance the competitiveness and the attractiveness of Casablanca Finance City. Having a government, authorities, and all the public and private concerned stakeholders strongly supportive is a priceless asset. It helped us to challenge the status quo continuously and helped us to position our financial center as a leading one in Africa according to the last Global Financial Centers Index ranking as number 3 in all the Africa and Middle East region behind Dubai and Abu Dhabi, and as number 30 globally back-to-back with Paris, ranked 29. GFCI, as you know, is the reference in the evaluation of financial centers. Factors such as the quality of the workforce, the functioning of the financial sector, the legal infrastructure, and the investment climate play a decisive role in a city's position in global financial markets. This is an impressive accomplishment that should not be taken lightly. If I have to shed light on just one example for what all the stakeholders have done together to promote the financial center, I would like to say some words about the success story of hosting Africa 50 Infrastructure Fund in Casablanca Finance City. And for the anecdote, that was the first time that Morocco approved the tax incentives to something that didn't exist yet, because we approved the tax incentive for Africa 50 in the 2014 Budget Act, and the Africa 50 Fund was incorporated 1 year later in 2015. Now, capital of Africa 50 reached 1 billion in early 2017, and the medium-term target has been raised to 3 billion, and it will be raised once again to $10 billion to be able to raise with a rating of single A up to $100 billion. This is really an African and Moroccan success story and the reward of ambition. In terms of partnerships, and because we are competing for talents on an international market, CFC entered into agreements with 2 leading financial services education and certification institutes to develop and densify a regional talent pool in Casablanca. These 2 institutions are the Chartered Institute for Securities and Investment in 2012 and the Chartered Insurance Institute, both based in London. We have now in Casablanca CISI and CII training and testing centers for more than 50 professional qualifications in financial services. The CFC entered into cooperation agreements with a number of major financial centers: Singapore, London, Luxembourg, Paris, among others. In addition to Montreal and Mauritius, in order to develop the derivative markets, sukuk, asset management industry, boost education and training in the financial services sector, and build an insurance and reinsurance sector targeting the wider African markets. CFC also entered into cooperation agreements with more than 15 investment agencies in Africa: Burkina Faso, Cameroon, Congo, Ivory Coast, Ghana, Guinea, Madagascar, Mauritius, Nigeria, Rwanda, Senegal, Tanzania, Togo, and Zambia. Ladies and gentlemen, as a result of all these efforts, there are now in Casablanca Finance City Financial Center more than 120 companies that have been granted the CFC status. More than 80% are already investing in Africa or exporting financial and professional services in the heart of Africa. And according to the Currency Exchange Office in 2015, Casablanca Finance City companies' investment in Africa represented more than 38% of all Moroccan investments in Africa. And 2016 statistics are more optimistic about the impact of CFC on the Moroccan economy in terms of creating high-value jobs in financial services and sectors that support them, and in terms of our contribution to African growth potential that can be serviced, catalyzed, and fertilized here in Casablanca. As Moroccans and Africans, we have to be proud of this achievement. But to massively catalyze and drain more investments, more international capital flows in investments in Africa, we need to do more. We need to connect strongly asset management industry to international investors in African assets. We need to connect our private equity industry to international investors in African companies. And finally, we need to connect Casablanca Stock Exchange to African capital markets and international investors. We need to list African stocks and bonds on Casablanca Stock Exchange. We need to have African depository receipts listed on Casablanca Stock Exchange. We need to dual list and cross list African company securities on Casablanca Stock Exchange and other African exchanges to add liquidity to the shares and allow international investors greater choice in where they could trade the African shares. We need also to take it seriously when there is an opportunity to take small stake to cement relationship between Casablanca Stock Exchange and other African stock exchanges. Most importantly, African stock exchanges could and should play a leading role if and where governments draw up plans to issue infrastructure bonds and exchange should do what it takes to list them. Imagine for a second the benefits of financing the Nigeria-Morocco gas pipeline deal to link Africa to Europe, financed by infrastructure bonds listed both, for example, on Casablanca Stock Exchange and Nigeria Stock Exchange. Finally, needless to say that African stock exchanges should be applauded for the service to our African economies. But African stock exchanges should challenge the status quo to play a role in financing African economies. They should play a critical role in improving the life of Africans. And they should ask authorities and governments for more smart regulations. Thank you very much.
Thank you very much to Mr. Mohamed Rashid. I think we've had the opening sessions. We've really charted in a very exciting way the positive relationship between the stock exchange and the business environment. So I was very happy coming here to learn about how the Casablanca Stock Exchange and Casablanca Finance City work so closely together, both to transform the business environment here, because obviously a stock exchange doesn't exist without a favorable business environment where people want to run businesses, people want to invest in their country, and foreigners want to invest in the country. And the stock exchange, if it can play a very positive role, as we see in Morocco, in that process, in partnership, that's good. And then also this incredible outreach into the rest of Africa, sharing expertise. If you look at some of the regional stock exchange development projects, if you look at some of the financial sector developments, particularly West Africa, but reaching right across the continent, you see the expertise of Moroccans and the strong backing of Moroccans. We're now moving on into the working sessions, and one of the most interesting aspects for stock exchanges, for securities exchanges, has been how they revitalize themselves, create new energy, new direction through the process of demutualization. And I'm sure the process of demutualization of a Nigerian stock exchange must be one of the biggest and most exciting demutualizations the continent will see, and an amazing process. So we're very lucky to have Mr. Akimbola Ogubanjo, first Vice President of the Nigerian Stock Exchange, and also Managing Partner from the firm of Chris Ogubanjo and Co. Solicitors.
Thank you, Tom. Bonjour, mesdames et messieurs. Good morning, distinguished ladies and gentlemen, all protocols observed. Let me begin by expressing my pleasure and delight at being in this ancient yet cosmopolitan and historic city of Casablanca, the economic capital of Morocco, and I extend a very warm welcome to all the delegates here present. I feel immensely honored to be giving the keynote speech to this distinguished gathering of stakeholders of African Securities Exchanges, and would like to thank our esteemed hosts, the Casablanca Stock Exchange and the African Securities Exchanges Association, for their wonderful hospitality. Indeed, I'm very pleased to participate in the 2017 edition of the Building African Financial Markets Capacity Building Seminar, because like the ASEA President mentioned, the BAFM seminar offers a unique opportunity to not only learn and discuss topical issues, but to also measure our progress towards effective global competitiveness. One of the ways in which we ensure our place on the global stage is through adherence to global best practices. Thus, I must commend the organizers for taking the time to select this year's theme, which clearly shows an appreciation of the role of best practices in realizing Africa's growth potential. It is therefore with a profound sense of anticipation that I look forward to the discussions that will be taking place over the next 2 days. Today I'm going to speak on a subject at the core of global best practices in the exchange industry and a developing trend in African capital markets being demutualization, which is evidently the most prolific shift in exchange ownership structures. Before delving into the topic of discussion, I would like to congratulate the CSE on the conclusion of its demutualization process on the back of a phenomenal year in stock market performance, gaining more than 30% in 2016, representing its highest gain in almost a decade. The post-demutualization performance of CSE is first-hand evidence of the benefits of demutualization, and we are now even more excited to conclude the demutualization process of the Nigerian Stock Exchange. We are also encouraged by the MOU recently executed by the NSE and the CSE in the presence of His Majesty, King Mohammed VI of Morocco. We are optimistic that this will spur more collaboration amongst exchanges across the African continent and further the development and deepening of our respective financial markets. Demutualization in the background. Until the early 90s, majority of the world's stock exchanges were non-profit, member-owned mutual organizations with monopoly power. However, beginning in 1993, with the Stockholm Stock Exchange, leading exchanges, including the Australian, London, Nasdaq, and New York Stock Exchanges, began to undergo demutualization. Demutualization is a term used to describe the transition from a mutual association of exchange members operating on a not-for-profit basis to a limited liability for profit entity accountable to shareholders. Essentially, demutualization separates ownership and voting rights from the right of access to trading on an exchange. According to data from WFE, the weight of mutuals dropped dramatically from 40% in 1999 to only 15% in 2016. In the same period of time, the number of demutualized stock exchanges increased from 10% in 1999 to 85% in 2016. Of the 66 WFE members, less than 10 are currently mutual. However, there has been an uneven pace of exchange demutualization observed between developed and emerging market jurisdictions. Within the first 10 years following the first demutualization in 1993, 21 exchanges in developed market jurisdictions successfully demutualized. In contrast, only 5 exchanges out of 76 exchanges in emerging market jurisdictions demutualized in that same period of time. In Africa specifically, out of the 27 exchanges who are members of ASEA, 7, namely the Johannesburg, Nairobi, Mauritius, Seychelles, Rwandan, Casablanca Stock Exchanges, and BRVM are demutualized, with several others, including the Nigerian Stock Exchange, in the process of demutualizing or considering taking on this initiative. Then you will ask, why demutualize? The decision to demutualize is a strategic one. Organizations that choose to demutualize make the decision for reasons that are unique to their growth objectives: to raise additional capital for expansion or for major technological investments, or to reduce control of intermediaries over the strategic growth of the exchange. The process can be cumbersome and expensive, taking several years to complete, and it is generally assisted by policies and regulations specific to the jurisdiction in which the company is registered. Nonetheless, the process has many rewards that far outweigh the short-term challenges. One of such rewards is the improvement in flexibility of governance structures that come with the demutualization. The for-profit model empowers management to make strategic decisions more efficiently, giving utmost priority to the interest of customers and the exchange itself. Demutualized exchanges are also able to restructure, merge, and form alliances with other exchanges and capital market institutions to maximize economies of scale and scope, accessibility, and market reach. In addition, more agility and flexibility enable exchanges respond more swiftly to increasing competition arising from the emergence of alternative trading systems and globalization. The primary factor that has driven the demutualization of exchanges is the increased pressure on capital market traditional sources of income. Technological advancements that have resulted in drastic reduction in trading costs and enabled exchanges to overcome national boundaries have also reduced the intermediary role of exchange members, thereby forcing exchanges to seek other revenue opportunities. As a demutualized entity, disciplined by profit-seeking, African exchanges will be in better stead to capitalize on new income opportunities, free from any limitations arising from conflicting member interests. To this end, it is worth noting that academic research on the effect of demutualization on the financial performance of 20 demutualized exchanges between 1996 and 2008 suggests that the return on equity increases by an average 5% to 20%, with the average net profit margin increasing by 14% to 30%. This is according to Rand Merchant Bank. Demutualization has also contributed positively to stock market performance. On the back of strong macroeconomic performance, improved regulation, and other factors, the JSE All-Share Index has grown by 280% since its demutualization in 2005 to reach 53,817.31 basis points as at the end of April 2017. Similarly, the Nairobi All-Share Index gained 16% since its demutualization process, reaching an all-time high of 176 points in February 2015, prior to the commodity bubble and global flight to safety, following the US Fed's increase in its benchmark lending rate. While African exchanges might have limitations in raising the funds required to effectively compete in a dynamic business landscape as member-owned stock exchanges, as demutualized exchanges, they can tap into the capital markets as a publicly owned stock exchange. Capital raised by African exchanges in an IPO or a private placement, like any other business, can be used to upgrade systems and attract high-caliber human resources, thereby enhancing its ability to compete domestically and internationally. Following demutualization, a number of our peers have repositioned their markets, building alliances or consolidating within and across borders in order to enhance their attractiveness. For example, in 2006, the Australian Stock Exchange merged with the Sydney Futures Exchange to form the Australian Securities Exchange, the ASX. The following year, the New York Stock Exchange merged with Euronext to form NYSE Euronext, creating the world's largest stock exchange with revenues in excess of $4.5 billion. More peculiar to emerging markets, demutualization could serve as a means of collaborating with strategic shareholders with specialized know-how aimed at importing international skills, knowledge, and technical efficiencies into our domestic markets. Additionally, it will enable African exchanges to be more agile and responsive to the intensifying global competition for capital market order flow, and presents them with the opportunity to expand into new markets. I will speak briefly about the progress we have made at the Nigerian Stock Exchange on our demutualization efforts. Study tours are vehicles for increasing our knowledge base, learning global best practices and processes, as well as establishing mutually beneficial relationships. Last year, in preparation for the launch of our derivatives market, the National Council and the Nigerian Stock Exchange Management participated in a technical tour of the Chicago Mercantile Exchange, the world's leading and most diverse derivatives marketplace, and the Chicago Board Options Exchange, the largest US options exchange. At the CME Group, the CEO at the time, Mr. Pufinder Gill, highlighted the crucial role of demutualization in enabling the CME increase direct access to its trading systems and develop high caliber staff. He opined that had the CME not demutualized, 3 of its subsidiary exchanges would not be in existence today. Accordingly, he urged us to remain steadfast in our demutualization drive. The same message was conveyed to us at CBOE, which recently joined ranks with other great blue chip companies listed in the S&P 500 after the acquisition of BATS Global Markets, highlighting its strong growth since going public in 2010. To strategically position the Nigerian capital market for the next phase of growth, I and my colleagues on the National Council, along with management, made the strategic decision to demutualize the Nigerian Stock Exchange in our overall ambition to reform the Nigerian capital market into a world-class market. Following this, we employed an extensive RFP process in the appointment of legal and financial advisors for the demutualization project in 2015. Recognizing the importance of demutualization to the vitality of our business model, the National Council held a strategy session in the first half of 2016, solely to discuss the stock exchange roadmap to manage issues that could affect the process, including potential regulatory and political concerns. Subsequently, a meeting between the National Council and past presidents of the exchange was held, with 6 past presidents in attendance to discuss solutions and insights on a clear path forward. The value gained with this engagement has dramatically enhanced the likelihood of a successful and seamless demutualization process. Today, we have submitted a draft demutualization bill to the National Assembly, which is the legislature of Nigeria, which will allow for our legal status as a demutualized entity. We have also completed 5 key reports in support of the project, including inception, legal due diligence, tax due diligence, member register review, and assessment of business and operational plan reports. In March 2017, we successfully conducted an extraordinary general meeting to formally empower the demutualization project team to fast-track completion of the project. With the expectation of the successful passage of the bill into law, the National Council management team and I will continue to devote our efforts towards completing all necessary documentation stipulated in the Securities and Exchange rules and effecting the requisite changes in our enabling constitution. Ultimately, we look forward to re-registering the exchange and assigning shares to members based on an agreed apportionment. I will now discuss a little bit, given my legal background, on the corporate restructuring considerations that you may wish to consider. I believe that corporate restructuring is of the utmost importance and should not be taken lightly as we collectively embark on this journey to create a more dynamic financial market across Africa. Exchanges may opt for a number of corporate structures upon demutualization. It may adopt a for-profit private company structure where only members and outside investors are the owners. Alternatively, the exchange can be listed on a recognized exchange, most times on itself, with or without restrictions on the number of shares that can be owned by exchange members and non-members. For most demutualized exchanges, a private structure is usually the first step before publicly listing. An example being the JSE, which demutualized in 2005 and listed on its own exchange in 2006. Notwithstanding the overarching corporate structure adopted by the exchange, demutualization brings new conflicts of interest arising from the objective to maximize profits and the self-regulatory function of the exchange. For-profit exchanges can establish a separate entity to conduct regulatory functions, thereby avoiding conflict of interest issues. This can take one of two forms: the independent subsidiary model, establishing a subsidiary with an independent governing board and management, separate from the exchange holding company, or the supervised subsidiary model, where the subsidiary's governing board is the regulatory oversight committee of the exchange holding company. Alternatively, exchanges can adopt the supervised division model, whereby the regulatory function remains with the exchange and reports to the exchange holding company CEO and ROC. The choice of regulatory model the exchange adopts will depend on several factors. Are there mechanisms to ensure adequate resources to meet the regulatory mission? What is the relationship between the regulatory subsidiary CEO and holding company CEO? If not independent, what is the relationship between the regulatory divisional head and holding company CEO? Further considerations would relate to who will be responsible for rulemaking, rules interpretation, and resolution of disciplinary matters post-demutualization. In conclusion, ladies and gentlemen, illiquidity and higher costs of capital characteristic of underdeveloped markets are known to deter foreign investors and steer capital raising efforts of large domestic companies to foreign markets. By listing on a stock exchange, demutualization provides an opportunity to unlock the value of African stock exchanges, providing an exit mechanism for former members and a unique opportunity for the public to partake in the profits of the exchange, thereby creating wealth for the general populace. Perhaps the most important outcome of demutualization for African exchanges in the long term would be addressing the liquidity challenges faced by African capital markets. Demutualization appears to be the logical next step for African exchanges, especially if we are to remain relevant in our role of powering Africa's economic growth and development. However, it is noteworthy that African stock exchanges must proceed cautiously, as certain key preconditions, such as a critical mass of stock exchange trading and related services, as well as a sufficiently liberalized market, are necessary to drive a financially viable operation post-demutualization. Other preconditions include the existence of the rule of law, a high financial literacy rate, and sound corporate governance practices, absence of which would undermine any demutualized regime. Therefore, African stock exchanges that do not currently meet these preconditions may wish to consider demutualization as a long-term objective. In the interim, these African stock exchanges should prioritize financial deepening, promoting professionalism and expertise, and enhancing macroeconomic stability necessary for building critical mass of listings and trading activity. Implementing a demutualization program can be a very complex undertaking, as I'm sure our counterparts who have already successfully transited will attest. The process represents a wholesale cultural transformation of the business, as well as a changing every dimension of the exchange. The fact that majority of the world's leading exchanges have embraced demutualization is indicative of the significant benefits that accrue to the entities that have undergone the process. However, a proper understanding of all the issues openness to new approaches, and a high level of cooperation amongst an exchange's stakeholders are fundamental to any successful demutualization. With that said, distinguished ladies and gentlemen, I thank you most warmly for your attention to a topic which I hope will embolden those exchanges that are yet to be demutualized. Je vous souhaite de fructueux débats. Merci beaucoup.
Thank you very much to Mr. Ogubanjo for giving us such a detailed description of some of, and also not sort of gilding the lily too much, but explaining some of the complexities, some of the routes, and also preconditions. I was happy to be involved in the demutualization strategy for Dar es Salaam Stock Exchange, and also the excitement when it did an IPO and the share price doubled in the first day of trading, because so many people were excited about the prospects of a stock exchange under dynamic management, moving into the new structure and playing a very dynamic role in the economy. And it was very interesting, you know, bringing stockbrokers more closely into the exchange, almost through the change of demutualization, gave a lot of energy. But now, don't worry about the time. We've got some interesting ways to catch up time later in the day, but we're pushing on into our next session, which is one of the key headaches that most stock exchanges probably around the world, and particularly in Africa, think about, and that's liquidity. And it's not the sort of liquidity that happens in the evening in the bar, but it's actually trading volume. And we've got two very renowned experts here to share their insights, and I'm sure they're going to do little presentations, and I hope there'll be one or two chances for questions at the end. But first of all, I'd like to, maybe you come up one by one and do your presentations, or yeah, you go up there and that'll be fine, because then you'll be able to take some questions. So we have Siobhan Cleary, who's Head of Research and Public Policy at the World Federation of Exchanges, and has a long history of being closely involved with African exchanges in helping both from Johannesburg Stock Exchange and working, as we know, with lots of the other African exchanges on helping people develop strategy and understand, and critically putting liquidity right at the heart of how that should go forward. And then Quinton Goddard, who's Principal Financial Services Market Infrastructure, Oliver Wyman, another great expert, well known to you, I think. So, yeah, two great presentations. If you'll come up and then do your presentations, and then we'll have some questions. Thank you.